In this video, I want to take you through and I want to talk about the Investor's Business Daily Trade Recommendation that just came out. Now, I, like many of you, probably receive these types of emails all the time from different resources. This is one of the ones that I have, and I just wanted to go through it with you, and I thought it would be fun to put on this trade recommendation and show you how to do that if you're getting this type of thing in your email as well and would like a little help putting these on. So the first thing that comes up and it says this is a trade recommendation for Marvel. MRVL is the stock symbol, and it says why this bull put spread in Marvel Technology quickly generates a 20% return. So let's go through and we're going to just quickly read the paragraph so we can understand what their trade recommendation is and why, and then we'll go over and we'll put it on in the markets. All right, so a few weeks ago we looked at a bull put spread trade on Datadog, DDOG, which worked out well. So today we're looking at a similar idea on Marvel Technologies, MRVL, specifically another bull put spread in the options of MRVL stock. Traders willing to bet that Marvel stock will stay above 60 for the next 5 weeks could look at a bull put spread that would expire March 15th. This type of trade will profit if Marvel stock trades sideways or higher, and even sometimes if it trades slightly lower. As a reminder, a bull put spread is a defined risk strategy, so you always know the worst case scenario in advance. So Marvel stock, here's the setup. With Marvel stock trading at $71.94 during the Thursday afternoon trading session, of course today is Friday, and if we use the March 15th expiration based on recent trading, we can sell a 60 strike put option and then buy a 57.50 put option for a total net gain of around 42 cents per set of contracts, or $42. Selling this spread would generate roughly $42 in premium with a maximum risk of $208. So what you're seeing here is you're seeing a reverse risk versus reward ratio. You're seeing that you're going to risk $208 to make $42. Why would anyone do that? Well, because the probabilities of this paying off are very high. And so because you have such a high probability of success, you're willing to do a reverse risk-reward ratio. So if the spread expires worthless, we would bag a 20% return in 5 weeks, provided Marvel stock holds above 60 at expiration. All right, so let's go put this thing on. I'm going to slide this off to the other screen, and we can refer back to it. So the first thing we want to do is we want to come in and find our Marvel stock, and here I've already got that pulled up for us. MRVL is the symbol, and you can see what they're talking about. Now let's first come in and do a little bit of technical analysis. Now this strategy makes money as long as the market stays above the strike price that they're recommending, which in this case is the 60 strike. So let's come in here and draw a line at 60. We're just going to draw our line across here at $60. Okay, so they're going to come in here. That's close enough right there. So we're going to bet that the market is going to stay above 60 with this strategy. That's what they're telling us. They think it's going to stay above 60. Let's do a little technical analysis on here. First of all, the first thing that pops off the screen to me is that we're at the top of a 3-drive pattern. Drive 1, drive 2, drive 3. Now this thing came up yesterday and popped up, tried to test this previous high and failed today. All right, so it didn't break it yesterday and it's failed and pulled back today. Now we know that the probabilities of this thing going into a 4th drive, it's not the highest. All right, it's not the highest probability that we're going to go into a 4th drive. Doesn't mean it can. It certainly can. Markets can do 4, 5, 6, 7, 8, 9, 10 drives. It's just the higher it gets in these drives, the lower the probability of a continuation. So let's draw a Fibonacci ruler in here and draw a retracement level. So we're going to draw our Fibonacci ruler for the entire move. And if it came back into the Fibonacci sweet spot, we would expect it to come back somewhere right around in here, right? This is the Fibonacci sweet spot. Now, they've put their line, or their line in the sand, basically, at $60. Well, $60 is right at the 50% level of the last major move, okay? So 50% retracement. This would be a 1, 2, 3 top formation in here. So we'd come in here 1, 2, 3 ABC, and if this thing continues to drop, it could be right back at the 161.8 projection, or even at 130.9. 130.9 is our golden ratio, but that would be testing this previous low right in here, right? So it'd have to break that previous low and then fall back down into that 38, 50, 61.8 region right in here for us to lose our money. It would have to be below this blue line right in here, this 50% retracement. Let's come in here and bring this down a little bit. Let's blow it up a little bit so we can see a little bit better. And so this is what we're playing against, all right? So this is the 3-drive pattern that this market's made. That's the top of an Elliott wave. So you have to take that into consideration. We're still going to go put it on because that's what their trade recommendation is, and I want to show you how to put on their trade recommendation. But I always want you to do your own technical analysis. Don't just believe these guys just because they put out a newsletter. Make sure you do your own technical analysis and you believe that this is the right move or strategy for you. All right? So we're going to come in, and the next thing they're going to do is they're going to say, okay, what we're going to do is we're going to sell the 60 strike. So we come in here. Let me clean up all of this. I'm going to come in here, delete all this drawing tool, and we're going to sell the 60 strike. Now, the first thing they said was we're going to go out March 15th is the expiration. I'm going to bring up my window down here so I can see my options chain. Come into our options. I'm going to go just into the traditional. You can see I've got 35 days down here, and we're going to center that, and you can see that this is where the market's currently trading right here at $70. Now, when they wrote the article, it was trading a little higher, but that's okay. We're still going to put on the same strategy. So we're going to come in here, and very simply, there's two ways we can, actually, there's multiple ways you can do this in track and trade. So the first thing you can do is you can come in here to the pre-built strategies, and they're calling theirs, their strategy is a bull put spread. In track and trade, we call it this would be a bullish one. It would be a vertical credit spread. It's the same thing. Vertical credit spread is a bull put spread. Now you can just select this right here, and we can drop that down and put it into the software just like that, or you can build it manually. You can use your drag and drop orders over here. You can drag a buy put, or you can drag a sell put, and you can put those on the screen and move them around. Now you can still move them around. We can come in here, and we wanted 60, right? Now let's put it at 57.50. So let's drag that down to, we need to drag it up. So we can drag it up to 60 right there. We drag it up to 60. And then on the other side, if we come in here and bring this back over, what did they say they want to do? They want to sell the other one. So we're going to, or buy the other one in this case, Marvel stock. So they're going to sell the 60 and they're going to buy the 57.50. So all we have to do is we have to drag the one we're selling to 60 and the other one to 57.50. So I'm going to put this in here at 57.50 right there. So that's where they have that one. They're buying the 60, or they're selling the 60, buying the 57.50. Now, if we come over to our little calculator over here, you can see we're going to receive $44 in here. And that's basically what they said. They said $42, but that was when the market was a little higher. So the return on our risk is going to be 17.6% or a margin requirement of $250. All right, $250 in this case is they're going to margin you at max loss. So with this strategy, with the way the market's moved, it's a little bit different from what they said. Max loss was 208 when they did it. For us today, it's 250. So we're going to have them probably around $250. They're going to margin you at max loss. The return on the risk is 17.6% or $44. All right, so that's the setup. Now, I want to come down here and show you something in the options chain. So what we've got in here is you can see the volume on here. This is the volume, 418, and the open interest is 2,694. We've also got 233 and 2183. So this is our open interest and our volume on here. I want to highlight something for you. I want to show you that, look, right here, this 65 is actually more popular than the 60. More people have purchased that or sold that 3617. There's a lot more action in there. And that's because if we slide that up, well, let's just bring it up right down here. Watch this. We'll put it up there on 316. And then, of course, you got 2073, you got 2694, and 21. The highest one here is actually down here at 29. We got 26 right here. I want to show you the difference. If we put this up here, look at how much closer this comes up here on the chart. This comes right underneath this area of support, and that's why there's a lot of action there. That's why there's a lot of people who put that there, because they're like, well, if it breaks below that point, we don't think it's going to come down and break that low. We think it's going to continue higher, so they put their orders or their options right at that level. Now, these guys are recommending a little bit more conservative position. They're saying, let's leave it down here at 60, and you'll notice that's down here giving it a little bit of a buffer, not right up underneath that area of support. So it looks like to me all of these areas are pretty popular. You know, the market's actually even got some up here higher, but right in here now, of course, we don't know for sure if all of these are selling a call or selling a put, or, you know, buying a call, buying a put. We don't know what they're doing. We just know that there's a lot of open interest, a lot of volume down here, but we can assume that this is one of the strategies that's very popular in here. The other thing is we got this down here, this 2996. That's a lot higher. So if we drop that all the way down there, which is very popular for a lot of people to do, you can see the little calculator. We now have a return on risk of 16.53 or $248. Now, that raises your margin all the way up to $1,500. you actually make a larger dollar amount, $248, but it's actually a smaller percentage of what you're risking, because you're risking your return on risk is based against your margin requirement. And so if you pull that green one way down here to $29.96 in the open interest, or in the volume down here, you can see that your margin requirement goes way up and your return on risk goes down, but your dollar amount goes up. So if you come up here and bring that back up here to, let's say, $26.94, you can see that your margin amount goes down to 500. Your return on risk goes up to 28.8, but your dollar amount goes down to 144. So it's a larger percent against your risk, but it's not as much dollar amount. So that's what people are playing against this on here. So you can do the same. You can take a look at this and say, well, if I'm going to put this on, am I going to do what they're saying, which is add a 60 strike? Or am I going to look at what other people are doing based on what the markets are doing, based on the areas of support, try and get a little bit higher return on my risk versus my margin amount? And you can play around with it a little bit. Just because they're sending out this recommendation doesn't mean you can adjust it based on your own personal preferences, all right? But we're going to put on just what they recommended. So we're going to come back down here, and we're going to bring this one down to 60, which is what they recommended. And they said 57.50 on this one. So they're going just one tick away, which is going to reduce the margin requirements very low, down to only $250, and you're going to receive $43 if the market stays above that red line. And that's really the game you're playing. All the market has to do is has to stay above that red line and hit that purple line above the red line, and you get to keep your entire $43. If it falls 1 penny below that, it hits that purple line below that red line, you lose your entire $250. So that's why you have to take into consideration how far you put this green insurance policy back. Because if you drop it back further, now you have the chance of your margin requirement goes up to $500. You have received $73, so you receive more money, but you're taking a bigger risk because the max loss would be $500 at this point. That's why you put it closer. You have a smaller max loss, and you're receiving a smaller dollar amount, but it's a higher percent. So if you have a higher percent, you can then come in and increase the quantity. 1, 2, 3, we'll put in there 5 of them. 1, 2, 3, 4, 5. So we put in 5 of them. And that way you now end up with more money, $215. You have a margin requirement of $1,250, but you have a return on your risk of $1,720. So it depends on what you want to do in here. You can kind of massage this a little bit, but let's go ahead and put this on just as they have recommended. And the way we would do that, we could come in here and bid for it. Right now they're asking the spread is $25. We could come in here and say, well, we're going to offer you, let's see if we're going to offer them $20. Let's see if they'll give it to us. Well, let's come down here. Let's even start at $10. Will you give it to us for $10? Let's go ahead and say place our order. And we wait for a second, and they say, nope, not going to give it to you for $10. The market would have to move against our position for us to get that $10. So we realize that. So we're going to say, okay, let's go ahead. I'm going to right-click on these tools up here on the screen. We can, of course, do that down here in our order tool. We can right-click on it down here either way. I'm going to say edit the multi-order. Of course, it brings it back into the screen over here. And then we can say, well, let's go ahead and let's offer them $20. Go ahead and hit modify, see if they take it. Wait for a second. Nope, they're not going to take it. All right, edit the multi-leg once again, offer them a little more. Now let's offer them $25 and see if they take it. If they don't take it, we have to edit again, offer them a little more money. There's $30. And eventually we might have to get all the way up to what they're asking for it, which is $48. But we're going to see if they'll take it at 40. Let's see, $44. Let's go $45. Oh, we're going the wrong way. We've got to go to 38. Going the other way, down to 38, 41, 40. That's $45. Let's go $40. Go ahead and see if they'll take that. Wait for a second. Nope, they're not going to take it. Go ahead and let's bid it one more time. We might have to go all the way down to 38. That would be $50 on the spread. That's a cost of doing business. Now, there's no commissions because we're in the stock market, but we do have to pay the spread. And we're doing it with 5 contracts. Well, 5 contracts times 50, that's $10 a contract, okay? Or $10 per option. Go ahead and modify that. And yep, they said, all right, we'll take that. And they went ahead and took their $50 of flesh out of us, all right? So that is how we put on the Investors Business Daily Bull Put Spread, all right? And if you have any questions, please let me know.